Alright guys, so we're going to go over what are options. So let's go ahead and type this out. What is an option, right? So an option contract is basically if you buy an option, you have the option, or I'm going to put in parentheses, the ability to buy or sell 100 shares at a strike price. So that is an option. Basically the most simplified term ever. So let's say I'm a heavy investor of the SPY. Right now the SPY is $394.77 per share. Well, let's say, and I own 100 shares of SPY, right? So 100 shares, that equals $39,477 is my investment. I invested $39,000 into the S&P 500. That is an insane amount of money. That's a lot of money that I'm risking. But let's say I think the stock is going to go down within, 4 or 5 days. I'm really worried that the stock might drop to $2. So what am I going to do? In order to protect my money, I'm going to buy an option. I'm going to buy an option put. I think the market's going down, so I'm going to buy this put that lets me reserve the right to sell my shares at this given price. So I'm going to buy an option put, and a put is the ability to sell 100 shares at the strike price. That's a put. So I have $39,000, right? $394, and I want to protect that, right? So I'm going to go ahead and I'm going to buy a put contract at $394. So if I go to $394, so I'm going to buy a put at $394, then I have the right to sell 100 shares at $394 per share. Here's the catch. These contracts aren't free, and they have an expiration date. So it expires, so date till expiration, DTE, I'll put that in parentheses, date till expiration, if I can spell correctly. And it expires within 30 days, right? Now, there are some contracts that expire within 0 days, and I'll show you that in a minute. But let's not get ahead of ourselves. So I buy this put at $394 that expires in 30 days. And this put states, I have the right to sell 100 shares at $394 per share. So let's say, hold on, let's backtrack. Now this whole contract, it costs me $4, or well, no, hold on. It cost me the contract premium is $5. Now, what do I mean when I say premium? Well, I mean that there is a price per share. So I don't get this contract for free, right? And there's a premium of $5. So right now, I owe $5 per share. So it's $5 times 100, which is going to equal $500. That's how much this contract is worth. This put is going to cost me $500. Now, why am I paying a premium per share? Well, this premium is kind of like the, if I was to, it's like an insurance, right? So it's going to cost me $5 to insure each share at $3.94. It gives me the right to sell it at $3.94. So the insurance is $5 per share. So I'm spending $500 to protect $39,000 at this price. So let's say the stock drops to $300 a share, right? If the SPY, my voice cracks, my God. The SPY drops to, let's say the SPY drops to $300, right? If I own 100 shares, what is that going to equal? That's going to equal $30,000. Now, that's a huge difference. I lost $9,477 if the SPY dropped to 300. But if I have this contract here, I have the right to sell 100 shares at $3.94 within 30 days. So let's say the SPY drops to $300 within 30 days. My premium that I paid doesn't matter anymore. I bought this contract for $500, so I get to sell each one of my shares at $3.94. So then I get back my $39,000, right? I get back my extra $9,000 that I lost. So I get to get back that $9,477 difference. I get that back because I get to sell my 100 shares at $3.94. Oh, well, I didn't put the 0.77, so $9,400. So, yeah, spend $500. If the stock goes down, I get to keep $9,400. Right? So in actuality, instead of losing $9,400, I just lost $500. That's why these contracts are so important. But that's a put. Now this goes both ways. It goes for a call. If I buy a call option for a call, so let's say the SPY is $3.94, right? So it's, well, yeah, $3.94. It's 394.77. And then I decide to buy the option of a call. That means I have the ability to buy the stock at 100 shares at the strike price. So let's say I do a call. I say it's going to go to $600, right? Or well, let's say I buy a call of $400. That expires within 30 days. So 30 days till expiration. And the premium on this is going to be a lot lower than the premium on this because I'm betting the stock's going to hit $400 and above. So I'm going to say the premium is 50 cents. 50 cents per share. So times this by 100, and suddenly the premium on this stock is, or the price of the contract is $50. So it's going to be $50 to own the contract. Now, a call is the right to buy 100 shares at the strike price. And the strike price is $400. So I get 30 days to buy 100 shares at $400. And all it's going to cost me is $50 up front. So let's say the SPY, instead of $3.94, it goes all the way to $600, right? So if it's at $600 and I decide to exercise this contract and I buy 100 shares at $400, well, I'm making a $200 difference, $200 in profit per share, and I got 100 of them. So if I'm making $200, a $200 difference in the stock price, I'm making 20 grand. Let's pull up the calculator real quick, just so I can show you guys the math. So I buy 100 shares times $400, because that's the price I'm paying for each share. So that's going to be 41212. That is $40,000 that I am going to be spending to exercise this contract. Now, for 100 shares, if I can spell right, 100 shares at $600 is going to equal 61212. That's going to cost me $60,000, right? But because I bought this call at $400, I bought all these shares at $40,000, and I can sell them for a 20 grand profit. Insane. And that's basically how contracts work. So even though the stock is worth $600, I can buy 100 shares at $400. And I can sell that if I want and pocket a $20,000 difference. And all I had to do was pay $50 for it. Now, obviously, these prices aren't real. These aren't realistic moves, right? The SPY only moves up and down like $30, $50 within a year. So actually, I don't know. The SPY gains a 10% return annually. So that fact was wrong I gave you. But the point is, that's kind of how the power of contracts work. Now, I can choose to not use the contracts. So let's say I buy a call at $400, 30 days till expiration, right? And the stock drops to, let's say the stock drops to $300, right? Or not $900, $300. Am I going to buy 100 shares at $400 if the stock's only worth $300? I'm not going to exercise that contract, but what I'm going to do is I'm just going to let the contract expire. I'll never use the contract. I'll never exercise this contract. I could sell the contract to someone else and try to make some money of my premium back, but as far as exercising this contract, I would never exercise it if the stock price is cheaper than what my option is. So let's go ahead and look at some real options on some real stocks. And I'm about to explain some other data. So let me just go ahead and pull that up. Alright, so I'm on my Google Slides. I'm going to present it. So as you can see here, this is a Tesla $740 call. At the time, I think Tesla was around, I think it was at like $700. No. I'm sorry, what was Tesla? I don't remember what Tesla price was at the time. But anyways, this is how the contract works. So this is a Tesla $740 call and it expired 7/22. And so I think I took this picture on 7/20, so it has 2 days till expiration, right? This contract is worth $23.90 in premium. So you're going to pay $2,390 for this contract if you buy at the bid. People are asking $2,485 for this contract. That's the ask. Let me go back. I accidentally clicked. But anyways, so this is the 740 call. Now we got to know that there's some things that we got to know. There are things such as IV. The high of the day was $31.95, and the volume is 13,000. The open interest is 3,000. So there's a lot of things we got to know. First thing we got to know is that volume means how many contracts were being bought and sold today. 13,000 contracts were being bought and sold. The open interest means yesterday 3,000 contracts were bought and sold. So if the volume beats open interest, That means today this stock is going off. And this is actually on Tesla earnings day. So now I can say, hey, there's a lot of volume in this option, and the highest price it was $31.95. If I buy this contract at $23 and I go all the way to $31, there's a huge difference. And this is times 100. So you got to remember, this is not $31.95. It's $31.95 per share. Times that by 100, now you're looking at $3,195. $2,390. That's a huge difference in money. And that's how much options can move. They can move thousands of dollars, they can move hundreds of dollars, and this is an example of a really good option, has a lot of volume, beats open interest. The only thing I really don't like is that it had the really high implied volatility. So that means the price right now is, earnings was this day, earnings was today, 7:20, earnings was today, and this call was a bit inflated because it had a really high IV. I recommend never buying a contract that has a IV higher than 100%. The lower the implied volatility, the better. Implied volatility is a factor on how much a contract is worth. If you're paying a lot of money for a contract and the IV is really, really high, that's going to tell you that, hey, you're overpaying for the contract. 109%, this contract's expecting 109% movement in the market. That's a lot of movement. It's already factoring in that movement into your price. So if the option moves 109%, that's what the price would be. And you're paying that now. So you're kind of overpaying for that option. Now, there's a lot of volume in this because a lot of people are trying to trade it. This option moves really, really fast and really, really big. Another thing you should note is the gamma. Now, there are Greek letters, and if you really want to get technical, there's a lot of things you can get into. And I really personally never got into Greeks. The only thing I look at is the delta. And the delta is basically tells me if I'm also going to overpay for the option. Delta also tells me that, I'm sorry, I'm blanking out right now, but I will explain all the Greeks in a later video because I don't know why it's just not recalling right now. But Greeks are very important. For me personally, I just know I don't want to pay for a delta that's higher than 1 or that's close. It doesn't go higher than 1. It goes very, very close to 1, and I don't want to buy a contract if the delta is close to 1. This is an example of a really, really bad contract. As you can see, no one is willing to buy this contract. People are asking 0.25, and the last trade was null because in that day, no one bought the contract. The IV was 189%. You're overpaying for the contract. If you were to buy it at 0.25, you're already pricing in 189% implied volatility. The volume was 0. The open interest was 0. So no one moved the contract yesterday, and no one played with the contract today. That's crazy. It's very, very crazy. This contract, you can buy contracts at 1 cent or $1, right? Because 1 cent times 100 is $1. You can buy it at $1, and then try to sell it at 0.25. But if no one's gonna buy the contract at 0.25, you're just wasting $1. This was another call option. Now, how people play option is that they play on premiums. So just like you don't have to exercise an option, but what you can do is you can buy an option, and when a stock moves up, the option will move up, the premiums will move up because it either becomes closer to the money or the premiums will move down because it gets further away from the money. And when I say in the money, out of the money, that's talking about a strike price. If the stock is, let's say this call was 17.5. If the stock was only worth $6, right, and suddenly went to $17.5, then the option would be worth a lot more because suddenly this option is profitable. But it doesn't matter how much the stock moves if no one's willing to buy the stock. If there's no volume, you're not going to sell your option. You can buy it as much as you want, but you're not going to be able to sell it. This stock has volume, or this option has volume, I'm sorry. So if the stock moves up, all these people are going to price the option with it. And they're also going to be willing to buy the option from you. Higher the volume, the easier it is to move in and out. So that was kind of your little quick overview on options. This is a really shitty option. You never want to buy options like these. You want to buy options that have a lot of volume in them. And so you find those high volume options in companies like Tesla, Microsoft, Apple's, S&P 500, the SPX. If you trade on Webull, you get access to the SPX, which those options move extremely, extremely fast. But yeah, so I hope you guys enjoyed. Let me go ahead and go back to my Google Docs right now. I actually went ahead and pulled up this option contract real quick, and let me just move this in the way. Oh, you can see my little Minecraft app. I'm a child inside. Anyways, so this is the SPY calls, right? I'm in calls right now, and so all this is technically within the money. And it has 2 days till expiration. This is within the money. So if I was to exercise this contract, I'd pay a $3.06 premium. 66-cent premium. So I'd pay $366 for this contract to buy 100 shares at $3.93. If the stock is $3.94, of course I'm going to want to buy my stocks at $393 because there's a dollar difference between that. But there's also calls to say, hey, I think the stock can move all the way up to $400 pretty soon. So if it's $3.94, I can buy a call saying it's going to go all the way to $400. Now the premium on this is 78 cents, right? Because that's how much people are bidding for it. Now let's say the stock moves to $400. This $400 contract is now going to be worth $3. There's an expression saying premiums have ranges. So if this was to go in the money, it'd be worth somewhere around $3. If this was to go, if the stock was to move to $3.97, this $3.97 contract would be worth around $3. So if the stock was to move, look, this is $3.99 is worth $1 right now. So it's worth about $100 for this contract. Now, if this stock was to move, let's say the stock moves $5, your $100 turns into $300 if the stock moves $5. $1 to $300, that's a 300% gain. That's 3 times your money. Whatever you invest in here, if it moves to, if the stock moves $5 and it goes in the money, 3 times your money. Now, note how the implied volatility on this stock isn't like 183%. So you're not overpaying for any sudden movements in the market. That's not priced in here. So you also get to see that there is a lot of implied, there's a lot of volume. So let me go ahead and move this here. The volume, 138,000 contracts being bought and sold, 101,000 contracts being bought and sold. The open interest was 12,000. This is significantly higher than my volume. I mean, my volume's significantly higher than this. My delta isn't at 1, so that's pretty good. That means I'm getting a good deal for the contract. The highest this contract has been is 372. So there's some room to make money. The lowest has been is 156. There's plenty of movement in the option to make money. That's all I'm telling you. Now, options go based off the market. So obviously if the SPY goes up, if the SPY moves up $1, anywhere from all these premiums all the way down here, $413, if it moves up $1, this premium actually moves up as well. Even though it's way outside of the money, if the market moves up $1, you could still make money on these contracts. So, but there's only to a certain extent. Obviously, you want to play with something that has a lot of volume. These contracts have almost no volume. But contracts like these have volume, 17,000, 127,000, right? I would play these options because, these would move pretty frequently. It has a higher chance of moving. Now you have contracts that are way in the money. So as we just said, 394.77. We can buy this contract $15,427. I can buy this contract and buy 100 shares at $240 each, compared to buying them at $394. There's contracts that move this much, and it's insane. Crazy, guys. That's the beauty of contracts, and you don't have to overpay for some of them. If you want to make money on options, you can go to these cheaper contracts as long as they have volume. This one has 5,000. I will play with the 407 call if I genuinely think the market's going to go up. If the SPY moves up $1, this 407 call, I can still make money on it. As long as it shows the stock moves up, this premium will also move up. You play on premiums, guys. That's how people make some serious money in the market. Now, there are contracts 0 days to expiration. That means the contracts expire today. That means, it's close. This is after hours, so the market has already closed, and so these contracts are kind of worthless now, because if they're not exercised, you don't have a lot of time to exercise them. So contracts like to die off towards the end of the day because they're not worth much. But 270 still priced in at 123, still paying very high for premiums here. A lot of movement in the market. So, and once again, suddenly in the money goes to 47 cents. Just crazy how stocks options move. And I never really recommend trading 0 days to expiration unless you're trading like the SPX, which that's on you. But calls and puts work the same. Puts works better if the higher the strike price, the better it is for you. Calls, the lower the strike price, the better it is for you. Just guys, look around for options, play the market. Really just do your research. I can only teach you so much, and if my teaching methods don't work for you, there's always the support chat. I'm always willing to help, but understand options is a really very important thing. That's all I really could tell you guys. You just gotta know how options work. As far as Greeks, don't try to overcomplicate it. I never really learned Greeks that well. I do know them. I don't know why I can't recall them right now. I'm just blanking. But yeah. Do your research, guys. That's all I really could say. I know I'm supposed to spoon feed you the information, but there's only so much I can tell you that, And if you guys still have questions, support chat's always open if you do pay for that tier. So yeah. I'm always around. Watch the videos. I'll definitely get more into that. Bid, ask, same thing like a stock, guys. Stocks have bids, stocks have ask. They move just the same, except the bid here is times 100. The ask here is times 100. All right, guys. That was your little options tutorial. I'll see if I can post more about some option stuff like that. But this information is very important. You always want to know your volume. You always want to know your open interest. You always want to know the delta. and you want to know the implied volatility. All right. I'll leave you guys be now. I'll see you later. Bye.